In this video, we are going to talk about the notes and financial statements part 1. The objectives for this discussion is to know the relationship of the notes with the other components of a complete set of financial statements, define and give examples of change in accounting policy, change in accounting estimate, and errors. Note the differences of the 3 accounting treatments. Define the events after reporting period and state the accounting requirements for events after the reporting period. The note provide informations in addition to those presented in other financial statements. It is an integral part of a complete set of a financial statement. So notes to the financial statements disclose the detailed assumptions made by accountants when preparing a company's income statement, balance sheet, statement of changes of financial position, or statement of retained earnings. These notes are essential to fully understand these documents. The notes are used to explain the assumptions used to prepare the numbers in the financial statements as well as the accounting policies adopted by the company. All the other financial statements are intended to be read in conjunctions with the others. So notes are structured with the following components. First is general information on the reporting entity. Second is statement of compliance with the PFRSs and basis of preparation of financial statements. Third is summary of significant accounting policies. Fourth is disaggregation or breakdowns of the line items in the other financial statements and other supporting informations. And last are the other disclosures required by PFRSs. According to PAS 8.5, accounting policies are the specific principles, basis, conventions, and rules and practices applied by an entity in preparing and presenting financial statements. When a PFRS standard or PFRS interpretation specifically applies to a transaction, other event, or condition, an entity must apply that standard. Changes in accounting policies. PAS 8 requires the consistent selection and application of accounting policies. PAS 8 permits a change in accounting policy only if the change is A. required by PFRS or B. results in irreliable or more relevant information. A business develops accounting policies in order to ensure the relevant and reliable financial information. In particular, the policy should yield unbiased information that reflects the economic substance of transactions and which faithfully represent the financial performance, position, and cash flow of a business. Here are some examples of changes in accounting policies. Change from FIFO to the weighted average cost formula for inventories. Change from the cost model to the fair value model of measuring investment property. Change from the cost model to the revaluation model of measuring property, plant, and equipment and intangible assets. The following are not changes in accounting policies. The application of an accounting policy for transactions, other events, or conditions that differ in substance from those previously occurring, and the application of a new accounting policy for transactions, other events, or conditions that did not occur previously or were immaterial. These are the following order of priority in accounting for changes in accounting policies. First is transitional provision in PFRS, if any. Second is retrospective application in the absence of transitional provision. Third is prospective application if the retrospective application is impracticable. Here is an example. During 20X1, APCO decided to change from the average cost formula for inventory valuation to FIFO cost formula. Inventory balances under each method are as follows. On January 1, the average cost is 1 million and FIFO values 1.2 million. On December 31, however, the average is 2 million and the FIFO is 2.1 million, and having the income tax rate of 30%. The requirement is to know the net cumulative effect of the accounting change in ABC's opening retained earning balance. Since we're looking for the opening retained earning balance, we are going to use the January 1's average inventory and FIFO inventory. And that is 1 million minus 1.2 million is a gross of tax of 200,000. So 200,000 multiplied by 70% is your net of tax of 140,000. And to record the retained earnings, Your inventory of 200 pesos will be debited. The retained earnings of 140,000 and deferred tax liability of 60,000 is credited. Moving on to changes in accounting estimates. Many items in the financial statements cannot be measured with the precision, but only through estimation because of the uncertainties inherent in business activities. A change in accounting estimate is an adjustment of carrying amount of an asset or liability or related expense resulting from reassessing the expected future benefits and obligation associated with the asset or liability. Changes in accounting estimates result from a new information or new developments and accordingly are not corrections of errors. The effect of a change in an accounting estimate is recognized prospectively by including it in profit or loss in the period of the change if the change affects the period only, or the period of the change and future periods if the change affects both. Changes in accounting estimates requires estimation in the net realizable value of inventories, depreciation, bad debts, fair value of financial assets or financial liabilities, and provisions. Here are the 2 steps in determining the changes in accounting estimates. First step is determine the carrying amount of the asset at the beginning of the period. And second step is depreciate the computed carrying amount in step 1, taking into the account any changes in depreciation method, useful life, or residual value. Here is an example in change in depreciation method, estimated useful life, and residual value. Our given problem is that on January 1, 20X1, ABC Co. acquired equipment for 1 million. The equipment will be depreciated using straight line method over 20 years. The estimated residual value is 100,000 pesos. In 20X6, following the reassessment of the realization of the expected economic benefits from the equipment, ABC Co. changed its depreciation method to the sum of the year digits. The remaining useful life of the asset is estimated to be 4 years and the residual value is changed to 50,000 pesos. The requirement is to compute for the depreciation expense in 20X6. To compute for the annual depreciation expense based on straight line method, we subtract historical cost to residual value, which is 1 million minus 100,000. And that will be 900,000 pesos divided by the estimated useful life of 20, and the total will be 45,000. And now to compute for the carrying amount on January 1, 20X6, you subtract historical cost from the accumulated depreciation. So that will be 1 million minus 225,000, which is 45,000 times 5 years, and it's equals to 775,000 pesos. Now moving to step 2, where the carrying amount of the equipment is depreciated over its remaining useful life. So using the carrying amount from step 1, which is 775,000 minus residual value of 50,000, and that will be 725,000 revised depreciable amount. Now multiply that to SYD rate, which is 4/10, and the equals is 290,000 pesos depreciation expense for 20X6. And to record the effect of the change in estimates in 20X6 in profit or loss, depreciation expense is debited and accumulated expense is credited.
Let's proceed to the next topic, which is errors. Familiar naman tayo sa salitang error. Ibig sabihin nito, merong mga naging pagkakamali or misapplication of accounting policy. Financial statements do not comply with PFRS if they contain either material errors or immaterial errors made intentionally to achieve a particular presentation of an entity's financial position, financial performance, or cash flow. Pag sinabi nating material error, ito yung nagkakos para ma-misstated yung nasa financial statement. Kapag naman sinabing immaterial errors, made intentionally, ito yung mga alam natin na fraud na sinadya ibahin or maliin yung financial statement. The types of errors according to the period of occurrence are as follows. The first one is current period errors. Ito yung errors na na-discover during current period or after the current period but before the financial statements were authorized for issue. Iko-correct natin to by simply correcting entries. And the second one is prior period errors. Ito yung error na one or more periods that only discovered during the current period or after the current period but before the financial statements were authorized for issue. Kinokorek naman to by retrospective restatement. Ano nga ba yung retrospective restatement? Ibig sabihin, tinatama mo yung prior period error as if the error had never occurred. Retrospective application. Ito naman, ina-apply mo yung new accounting policy na yung policy na ginamit mo from the very start. Here's the example illustration of current period error. On January 10, 20x2, prior to authorization of ABC Company's December 31, 20x1 financial statements for issue, the accountant of ABC Company received a bill for an advertisement made in the month of December 20x1 amounting 400,000. This expense was not accrued as of December 31, 20x1. So the requirement would be prepare the correcting entries assuming a book are still open and books are already closed. So the first requirements is to assume that the book requirement are still open. When we say the book is still open, ibig sabihin hindi pa nakakapag-close yung entry. So nominal accounts can still be used in correcting entries. So the answer would be December 31, 20x1 debit advertising expense 400,000, credit advertising payable 400,000. So the next requirement is to assume that the book are already closed. It means na kapag closed na yung entries at hindi na natin pwedeng gamitin yung nominal accounts, kaya ang gagamitin natin for correcting entries ay yung mga real accounts. So the entry would be January 10, 20x2 debit retained earnings 400,000, credit advertising payable 400,000. If income tax is not ignored, the entry if the book are already closed is as follows. Assume an income tax rate of 30%. So January 10, 20x2 debit retained earnings 400,000 times 70%, 280,000. Debit income tax payable 400,000 times 30%, 120,000. Credit advertising payable 400,000. Period error. On January 15, 20x3, while finalizing its 20x2 financial statements, ABC Company discovered that depreciation expense recognized in 20x1 is overstated by 400,000. So the requirement would be ignoring income tax. What is the entry to correct the prior period error? So the entry would be January 15, 20x3 debit accumulated depreciation 400,000 and credit retained earnings 400,000. Types of errors. Number 1. Errors principle. These arise from the lack of knowledge of accounting standards or procedure. Kapag hindi ka aware sa standard or procedure, it means you have an errors in principles. Pangalawa, clerical and similar errors. These include mathematical mistakes, oversights, or misinterpretation of facts. Examples: Transplacement error. When the number of digits in an amount is incorrectly increased or decreased. Halimbawa nito, 1,000 amount is recorded as 100 or 10,000. Next, transposition error is committed when digits in an amount are interchanged. For example, a 15,652 amount is recorded as 15,625. Yung nagkakabali-baligtad yung number. Errors of omission. For example, the accountant forgot to record a transaction. Errors of commission. For example, the accountant recorded a transaction twice or partially. Ibig sabihin, yung dobleng nare-record ng accountant yung transaction. Compensation error. For example, a 500 overstatement in the sale account is compensated by a 500 overstatement. The erroneous credit is compensated by the erroneous debit. This error would not be revealed by the trial balance. Accounting system error. For example, there is a bug in the computer program. And last one, counterbalancing and non-counterbalancing errors. Let us focus on this type of errors. First is counterbalancing errors. What would be the effect of counterbalancing error on year end? Sa profit or loss in year 1, it would be overstatement. In year 2, it is understatement if the error remains uncorrected. However, the profit in year 3 would be unaffected. And the effect in financial position. In year 1, it would be erroneous because it still have an error. In year 2 and year 3, it would be unaffected. Example of counterbalancing errors include errors relating to the following. Number 1, inventory. Number 2, purchases. Number 3, sales. And 4, prepayment and unearned items. And last, accruals for income and expenses. Non-counterbalancing errors. It is opposite in counterbalancing errors. Non-counterbalancing errors are errors which is remain uncorrected, are not automatically corrected or offset in the next accounting period. So, effect on non-counterbalancing error on the profit or loss. For example, if a non-counterbalancing error process in profit or loss in year 1 to be overstated, the year 2 and year 3 would be unaffected. However, in the statement of financial position, in year 1 to year 3 would be uncorrected or erroneous. Example of non-counterbalancing errors include errors relating to the following. Number 1, misstatement in depreciation. Number 2, erroneous capitalization of costs that should be expensed outright. Number 3, non-capitalization of capitalizable cost. Relationship between accounts. In periodic inventory system, the following relationships between accounts can provide guidance in determining the effect of counterbalancing errors on profit or loss. To see direct relationship, it means if an ending inventory is unstated, profit is also understated. The following other relationships are derived from the relationship shown above. Ending inventory. Cost of goods sold, inverse relationship. In beginning inventory and purchases, cost of goods sold, direct relationship. Beginning inventory and purchases, profit, inverse relationship. Asset related account, profit direct relationship. It means if the assets related account is understated, the profit should be also understated. Some of the examples are the error on prepaid assets and error on accrued income. Next, liability related account, profit inverse relationship. If a liability related account is understated, the profit is overstated. That is the meaning of inverse relationship. The example of these are error on unearned income and error on accrued expense. Events after the reporting period. Ang sakop ng events after the reporting period ay ang mga sakop ng end of reporting period and the date the financial statements are authorized. What is date of authorized? Ito yung date na ino-authorize per issue ng management regardless kung final na ba or subject to further approval. Here's the example of this. So, the analysis of this example is on January 1, 20x2 ang end period at February 5, 20x2 ang date na ang authorization. Kaya, mula January 1, 20x2 to February 5, 20x2 ang events after the reporting period. There are two types of events after reporting period. Adjusting event after the reporting period. These are the events that provides evidence of condition that existed at the end of the reporting period. And non-adjusting events after the reporting period. Ito naman yung events that are inactive of condition that arise after the reporting period. Lastly, disclosure. Ano nga ba ang dinidisclose sa notes? These are the followings. A. Date of authorization for issue and who gave the authorization. B. Unupdated on the disclosures to include the effect of adjusting events. C. Non-adjusting events that are material including the nature of the event and an statement of its financial effect or a statement that such an estimate cannot be made. That's it for Notes Part 1. Thank you for listening.